Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Thursday, December 1st, 2022. So as we head into the first trading day, the final month of the year, what I'm going to do here is just a brief, kind of touch lightly on the big things, the major things that I typically cover on a fairly regular basis, and those are the main asset classes: stocks, bonds, commodities, gold. I'm not going to spend a lot of time because there's not much to add that I've said that I got one chart out to you today. It's not the be all end all, but these are those very significant downtrend lines on all the major stock indexes. So this is the first tag that we've had of that. And again, when I say primary bear market downtrend lines or primary downtrend lines, that means off the all-time highs in the markets. That's when the bear market started back around, at least for the S&P 500 in the beginning of the year. And NASDAQ pretty much double topped at a slightly higher high back in November. I'll get to that in a second. So, is it possible we go right on through these? Sure. Is it likely? No, absolutely not. And that's, again, I always trade in probabilities. You're going to have sellers step in quite often on such an obvious and technically significant level. And so far today, you already had that. So, I had a short-term trade out there for you this morning, which I'll update. That one pretty much hit. We were looking just for a quick pullback, about a 1.5% pullback, and we got that. And I think we're going to have more than that. I think we'll have another opportunity to recycle back in and do that again if you took the quick profits. All right, so in addition to the downtrend lines, you also have the key 200-day moving averages, and as I've talked about, it's fairly common to slightly overshoot those when you go to test. Again, you have two lines here. You have the blue is the 200-day simple moving average, and the red is the 200 exponential moving average. So you can see it checked at the 200 there, it stopped at the 200. I'm sorry, the exponential there, the simple there. The simple capped it there, but here's a period where you got above there for about a week or so, just like you did here, and you're a little bit above it now. But as the bear market goes on, remember back then you had a lot of non-believers. These were dip buyers. We weren't technically in a bear market then, so the word bear market was maybe being floated around by a few, but not many. And so therefore, where I'm going with that is typically you get into the once people realize you're in a bear market, then those levels, I think, usually do a better job of capping the advances. So we'll see. Again, it's all probabilities. That's it. Anything's possible, but so we'll look at probabilities, and you have the S&P 500 in very close proximity to the 200s. In fact, we took out the simple 200 simple yesterday with obviously what I'll call momentum fueled overshoot. There was unarguably a lot of short covering there. That'd be hard to argue. And again, I get my thoughts out as soon as possible. This, to me, it was a non-event to the market. It was obviously a big event. But just even listening to others, I don't think anybody out there really expected another three-quarter point. We knew the Fed was going to eventually slow the rate of hikes. That's it. So it's not a pivot, at least from hawkishness to bearishness. It's just hey, we've seen a heck of a ride, one of the biggest rate hikes cycles. What was that? 4 back-to-back 75 basis points. And when you look at again where you come from, near zero, that's a big deal. So, anyways, slowing down, and we'll see. I think the market overreacted. And on that too, I saw a comment yesterday, or I checked it today, saw it, and I replied to it. Somebody posted, biggest point gain on the Nasdaq, I don't know what it was, 7th, 9th, 11th, somewhere down there, and such and such on the S&P 500. Remember, the media's job is to get you to click on links and read, MSNBC or I should say CNBC, or all of them, CNN, Fox Business. They all want you to click and read their news. They're going to post, clickbait, dramatic headlines. To me, it is almost completely irrelevant and somewhat misleading, especially those that haven't traded or been in the financial markets, to quote point gains. Why is that? Well, for example, one of those was a NASDAQ composite and COMPQX. I'll give you the NASDAQ composite, go back. And here's one reason as well that we use, or I do, log scale charts instead of linear or arithmetic scaling. So back here, when you were in the 90s, early 90s, the Nasdaq was about a 340 point or 330 point index. So a 10% rally would be a gain of what is that? 33 points, right? From 330 to it'd be a 33 point gain. Now 33 points is nothing. We're almost flat today, and it's it. We're up 20 points right now because it's a 11,500 point index. So again, please, whatever you don't get caught up in point gains. I don't even. People sometimes ask, "What's the S&P at the top?" I don't even know. My brain works in percentage gains, and that's all. We know that the biggest rallies come in bear markets, and there's been plenty of big green candles like the one yesterday over the last year, and just as there's been plenty of red candles often answered, following a big green candle. So again, the takeaway is if anything technically significant occurred, I'd let you know. The only thing, and I'll play devil's advocate here, try to cover everything. What I will give credit to is if you turn off all the lines here, we essentially, not by a lot, but we took out the previous high. And remember, the definition of a uptrend is any security making a series of higher lows and higher highs, and so that's what we have. Not by a lot, but so it keeps this what is the near-term uptrend intact, but the intermediate-term trend since the Nasdaq peaked back in November is still clearly bearish without. There's the peak right there, without any evidence of a reversal yet. So, like I said, when in doubt, go with the prevailing trend. I'm still working on that mindset. I've also said repeatedly lately, look, I keep things light around the end of the year between Thanksgiving and New Year's. This is what you get. You get these kind of whippy out of nowhere moves, whipsaws, and it's just par for the course. So I can say this, that if I didn't have this site and you guys subscribers, I'd be it's sitting in front of my desk a whole lot over the past few weeks and going forward in the coming few weeks here than I normally might be. It's a great time, like I said, to take some time off, keep things light, because again, I'm just sharing my experience. That's always been kind of a tough month to trade for active trading. But with that being said, I'm going to go over some opportunities for you here. So going back to where we were, you saw the S&P 500 on that board I showed you. Just a clean, simple board with the downtrend line off the highs, and there it is. And then, of course, the more complex board here, it still has that downtrend line, but you have my what I consider my most likely bear market rally target zone, and it's a zone, so there's no hard entry, hard short. You short into the zone. Now, when you're at getting towards the top of that zone, you at least I do start increasing, and that's what I did yesterday. I'm starting to build back swing shorts in long-term accounts like IRAs and things like that. And then there's the possible, this is the probable or most likely bounce target zone. This is, of course, everything's possible. This is less likely all the way up to that 428 level. And then again, you take much beyond that out, you start to take out previous highs, and it really starts to kind of muddle the case, if you will, that we're still in a bear market, and this was not the end of the bear market. Okay, doesn't eliminate it completely, but it certainly chips away, because at that point you're well past the 200-day moving averages. And remember, that's just the S&P 500. You also have the Nasdaq 100, which also hit its bear market downtrend line off the highs back here. And so there's another, and also in very close proximity to the 200-day moving averages. In fact, we're right about on there right now. There's a 200, the red line right here is a 200 exponential, and there's a 200 simple. That's where you got rejected last time off the test of those moving averages, and there as well, pretty much throughout the bear market. And again, it's common in bear markets. Once a bear market starts, those are your gifts. I call them gifts for swing and trend traders. Rallies back into the 200s to start shorting for the next swing trade down. Swing down, swing down, swing down, swing down. And of course, there's never any guarantees, so that's what stops are for. You figure you need to determine where you believe things are going. I've shared that, and many other. The next leg down should take out the previous lows. So you figure where your stop's going to be, and that'll be relative or commensurate to your price targets. Um, Let's take a look at QQQ. QQQ, unlike IWM and SPY, doesn't have a perfect, very clean downtrend line. It's still good enough. I use the January, even though that was technically the high, you don't have a clean the trend line there. It would come way up here like that. And who knows? That's even possible. You could still see a bear market that looks like that. It's just one you're not going to want to ride that out short if this trend line here, again coming off the all-time high and then the subsequent high, which was a hair lower back when the Dow and the S&P peaked in right around the beginning of the year. And you could say, well, you have three lower highs, and you could also have a downtrend line. But again, that's not. I don't think that's a very likely scenario now. It's certainly possible, and that's what stops are for. And like I said, the Nasdaq has been lagging on this advance up in a relative terms, the percentage, the retracements that it's had so far off the lows, and it's still well below the 200-day moving averages. Last time it checked the 200 simple, checked the, exponential there, checked the simple there, checked the both of them right here, and so that that's why on that one I have a range, and it's a pretty thick range, not too much, but runs about from where we're at today, and we hit it once before, and we pulled back. We hit support here. We bounced. We closed on it yesterday, as well as the downtrend line, and there we are. We're getting so far. It's price resistance. It's that previous reaction high, and it's a 294.20 level. If you can see my line right here, it goes all the way back. I'll show you why it's there and why that's the bottom of the range. You have quite a bit of support. You have a gap right here. You have a lot of candles, all those circles there, a lot of reactions there, and it was support here, and then once that support was broken, that gave us the last leg down so far, and we came back, got rejected, and we're there again. So it's simple. I know how this works. I've done this long enough to read comments, talk to other people. They, a day like yesterday just feels nothing but outright bullish, and people tend to, a lot of people tend to suffer from what's called a recency bias. I mean, we are and have been in an uptrend off the lows. So I'm going to acknowledge that. And then you have a big day like this and takes it to really didn't. Technically today we popped that previous high, but now look, we're back down to there. So like I said, I keep things in a sense kind of simple. And if you're in a bear market and you believe you're still in a bear market, you want to short rallies into resistance. Not each and every one. Depends on if you're shorting, for a quick pullback trade, or you're starting to add back trend positions, which I've been talking about over the last couple days here, is adding back trend positions for what could be the next move down. And what looks like is when I talk about scaling in, it's little here, little here. If it goes up here, there's a 200-day and a secondary downtrend line. You can see I have right here. Here, let me show you that real quick. This is a secondary downtrend line. If you come off the same highs right there, and then you capture this peak high right here perfectly, then you can see you have a perfect, it aligns perfectly with the 200-day simple and exponential. And so the thing about it is, that would be certainly a better, quote unquote, a better place to short, is its higher levels. When you're shorting stocks or the index, it's just like buying in reverse. When you buy something, whether it's a TV or the your Apple or the Nasdaq 100, you want to buy it as low as possible, right? That's the whole goal. And when you're shorting, you want to short something as high as possible. Problem with that is sometimes in a trend, in this case in a primary downtrend, you may not get that perfect entry. So that's why scaling in. Scaling in means if we never get there, and we start to go down, then I'll continue to add to a swing or trend short strategically. There's a nice support level there. And let me just say this, and I'll end it here, and then we'll move on to the other stuff. That you can just see that's a nice support level right here. We had this is really the trading range for the last few months now, where And I warned of this back here that we'd probably grind around, especially with the holidays coming up, and that's what we have done. Now, a definitive breakout, a solid breakout above is probably going to bring us up to that next level, whereas a rejection down below would probably bring us down to the bottom of that range again. But if we get rejected soon and we move back down, we're going to wipe this candle out. And in a bull trend, that usually shouldn't happen. It's going to be quite bearish. A lot of folks bought based on Powell's comments yesterday. A lot of that was algos, really. Computerized trading programs firing off and jumping in, and a combination of everything. Natural buying, short covering, and then the algos just jumping on board and exacerbating the move. That's what happens. But where I'm going is, it's set an alert. I'll do it right now on mine. If we drop below that 290, 279.70, I think that if that happens, I can tell you right now that would be a very bearish technical event. It would be a break of a pretty significant support level and also wipe out or undo this whole big green candle there. And I think that would very likely has the possibility to spark the next wave of selling down to the lows and maybe catch a lot of traders off guard. So we're far from there right now. I mean, it could be one bad day. When you look at these big candles in the past, that's what you get in a bear market. This is, again, just a it's a fairly typical move, and again, look at everything in percentage terms, not points. And then also on top of that, look at a big move like this. If you get a big green candle like that and it breaks out, let's say, for example, we rallied up to the 200 and tested them for a little while, worked off the overbought conditions, and then you see a big green candle that breaks out. It takes out the downtrend line, takes out the 200-day simple and exponential moving average. Well, you got to say that is a technically significant move. So I don't dismiss all big moves just from the fact it's a big move in what may be a bear market or maybe early stage bull market action. Again, if it's a big move that makes that's technically significant, such as a break of a major support level or a break out of a trading range such as this, then I give it a higher weighting. As of now, to me, yesterday was nothing but noise. And then there's that whole thing called short-term trading on the other end of the spectrum. And those are usually, I'll define it as trades lasting minutes, hours, maybe a couple days at most. Like this one, we were right about here when I got that post out to you, just off the highs. We had that nice big divergence here on the 10-minute chart. And like I said, I was only looking for a 1.5% drop. I always give you the actual support levels and say always cover short just below support, because if it's a well-watched support level like that, the buyers are going to step in early. So that's right about where you should have had a stop loss. A buy to cover limit order, and so that was good for about a quick 1.5% pullback there. And again, it was pretty big divergence on the 10-minute chart, and now on this chart. Well, that's all I could see on looking at this 10-minute chart. But what I just showed you on the daily, this right here also coincides with a rally into a more significant resistance on the daily time frame. And as such, we may get another move down from here. Wouldn't surprise me one bit. Right now we're in no man's land. I don't see. You can flip a coin whether we're going to go higher or lower between now and the end of the day. This was the only trade I saw today on NQ. I don't see any other, other than maybe if you reversed and went long for a bounce, above that. That was a very, very obvious pullback target, that 930-ish level right there. Okay, I'm going to roll now into the other things, and again, I probably went a little more in depth on the markets, but I think that's important. The equity markets are usually where the bulk of my focus is. The other thing, in recent months I've been talking about the negative feedback loop. I don't know if you can make it out. This chart was posted on November 10th, and I even did a video talking about that. And it's just really a vicious cycle, if you will, or again, what's referred to as a negative feedback loop. And so you have lower rates, and again, I put here expected or actual. In other words, the fact that the Fed, everyone was, or at least I was, a lot of people assuming the Fed would probably slow the rates of ascent on these hikes down. In other words, not another 75. You can't keep doing 75, 75. All of a sudden, we're going to, like I said before, everything would crash. The economy cannot, sustain such sharp rates. So they're slowing down, backing off, and so that's what we had yesterday. And then then the loop goes like this. Once you get to anything out of the Fed that the market perceives as dovish or less hawkish again, and, got to be very careful on how I phrase that. Then stocks rally, but so do commodities. And I looked yesterday, sure enough, green across the board. DJP, oil, everything, almost all commodities rallied, and so that's the vicious cycle. Because of that, so when you see these abatement inflationary forces, then there's a talk that the Fed can slow down or stop rate hikes, but then you're going to see commodities rally with that. And so when rising commodity prices go up, that's inflationary, and then it's going to again force the Fed's hand to keep keep applying the brakes by keeping rates high or continuing to raise rates. So there's really, listen, I'm not going to say that there's no way around this, that we're destined to be in this spiral forever. No, what you want to watch, if you are trying to get an idea what 2023 is going to look like, is the bear market over? Did it end in October? And where do we go from here? Are we embarking on early stage new bull market action now? Well, I would watch commodities closely, because myself, and I can tell you the institutional investors, we are in an inflationary environment. You can do a Google search, go to Google Trends, type in the word inflation. You'll see the surge, in searches. Inflation was never an issue. It was always out there, always talked about in the investment community. But we were coming off decades of very low, unusually low, persistently low inflation, and let the Fed get away with a lot of excessive monetary policy, and that's no longer the case anymore. Okay, and where I'm going with that is, as such, we had, and this was again back on November 10th. Here's QQQ in purple. Go up a little more, market will rally, but then so will commodities, and that's what we've seen. And then you're going to get the next leg down, because when you go back in time, remember, for all the way since 2008, that's when commodities started a great bear market that just ended around the time COVID hit, right when the stock market bottomed in February or March of 2020. That's when commodities bottomed. And so back then, both were falling, and that was a tailwind for stocks that allowed the Fed to be very easy. And so again, where I'm going with this is, it wasn't really a thing then. Now that inflation's a thing, I can tell you that institutional investors, pension funds and mutual funds, hedge funds, they're going to, as long as we're in that inflationary environment, you're probably going to see them continue to buy dips in commodities and keep that bull running. And then again, this whole, now this is not a timing thing. Just like those PPO crossovers yesterday, they're not exact timing indicators. They show you when the trend is changing. Those that were close to firing the other day obviously didn't fire with the lift that we had the other day, but we're still in very close proximity on a lot of those sectors that haven't yet already crossed over. So it could take, it could be, who knows? Could be days or even weeks before we get those crossovers. So that's still something to just monitor. And again, that was not an exact timing indicator. It's just kind of like this, something to watch. And so you want to watch commodity. Oh, here's commodities. And so let's roll into that. Let's jump over to commodities real quick. Let's go to DJP, which is really, again, there's a lot out there. It's one of many broad-based commodity ETFs, but it's pretty well diversified. That's why I like this one. And you can see now we're down today, but yesterday was an up day. I had most commodities green across the board, and I've been able to, pretty accurately predict where the CPI is going to come in. That's the Consumer Price Index. It's the best measure of inflation. Based on this, and it's about a 1 month lag time, even though they take the data throughout the month. In other words, the November data will be coming out soon. If I checked it recently, I'll get to that in a minute. But let me turn off all the lines and show you. So here's November 1st, right? Nope, right here. So here's November 1st. This candle will zoom in nice and tight. Yep, I got it on the 1st. That's where we closed, and here's where we are. We were, this. You can see if you just box it in here. Let's do it this way. This is how I look at this. There's all kinds. This is not a perfect calculation. They use a lot of things. What we're lacking here is real estate. I'm going to get to that in 1 second. But you can see from this is the candle right here. From the first, we are up. Inflation has increased throughout the month of November. So when the November data hits, and remember the problem here is there's about, I noticed quite often a 1 month lag. But even then, if that's the case, now we go back to October. Here's the month of October. And let me find October 1st candle. 29th, 30th, first day of October was the 3rd, but obviously, the government is using, the calendar month, and so you're really right about here. That's not the tool I wanted. I wanted to turn that off. Let me turn these lines back off. You see where I'm going, guys. This is October up here. This is November. So inflation has been creeping back up. That is going to be reflected in the numbers sooner than later, and that's part of that vicious cycle. And again, there is a lag time. It's not, sometimes the market will tolerate increasing commodity prices. The other thing is the housing market, and unfortunately, see, I like commodities because we can price those in real time. Corn, wheat, soybeans, crude oil, everything that causes inflation there. All commodities, they trade on exchanges, and so minute by minute, second by second, and many of them around the clock when you're looking at the futures, or they're trading around the world, you know where they're at. Housing market's a different story because there's such a lag there, but it doesn't take a rocket scientist to know that the biggest thing there is interest rates. This is a 30-year yield. I'm going to look at the 10. I heard years ago, and it seemed to be that the 30-year mortgage rates typically track that the 10-year bond, the 10-year Treasury bond, a little better. But either way, you can overlay TYX, the 30-year yield, and over TNX. They move almost in perfect concert. And what you can see here is, look, there's a drop in yields. And so where I'm going, we peaked, and this was a trade we had on bonds, and still is a trend trade. I personally took out, I told you a few days ago, I took half in the 401k monies. That's where I had the biggest position as a trend trade. Took half of that out, and then today I did the rest. It's just not worth it. I'm going to tell you why in a second here. I think the risk reward at this point in time after today is just not as favorable as it was a few weeks back, a couple months back. But where am I going? Okay, so TNX, the yield on the 10-year has dropped down from about, what is that, about 4.3% down to about 3.5. Remember, mortgage rates are going to be higher, and 30-year bond yields are going to be higher. But that's a substantial drop. It's an 18% drop in yields. But again, that's just not not 18% on the interest, just the drop in the percentage drop in the yields. And so again, it doesn't take a rocket scientist to say that that's been bullish for the housing market. And we probably, and these numbers won't come out because there's such a lag, but we'll probably have seen maybe not necessarily a surge, but I would say at least a stabilization or a bounce back in real estate prices. They've been coming down, and we finally, all these rising rates, the 7+% mortgages, finally the numbers are coming in that the housing market was making a hard turn. And again, this stuff is going to be popping up. So it goes back to that whole negative feedback loop. Whereas when you see yields come down, it's going to make the housing market more attractive. And when home prices go up, rents go up, and that's what they look at in the CPI. They use actual rents and owner equivalent rents. They don't technically use home sale prices. But that is all, again, it all moves together. If home prices go up, 40% over, so many years, rents are going to climb, accordingly. Okay, more on the technicals of the bonds. So I have, here's why I just, again, I'm not going the other way, but here's why I took profits on some trend positions in bonds. That was a target, has been for a long time. It was this previous reaction high. It's really a support zone on the 10-year yield, and it runs from about right about 3.5% or so, 3.5. And you can see we're right there, and it's good support. It was this previous reaction high. We back tested it after we broke out there, and we're there again now. We could continue to fall. If we go down through there, you can see my next support. And ultimately, I think before this trend is over, I think this was a significant top. We're going to come down here. So there's nothing wrong with, sitting back and, whether we bounce or not, riding out of bounce. We'll probably work our way down there before all said and done. Maybe all the way here to this 2660, which is a 2.7% yield right there if we come down fast. But again, we're at support now on TNX, TYX. Same thing. You have trendline support right here on the 30-year yield, and we're a hair below it. But sometimes you break down intraday or even close only to see us hold that level the next day. And when you go down to a 60-minute chart here, I'll even zoom down to ZB. Here's the bond futures. And so you can see here, ZB is the 30-year Treasury bond. You had support. We broke that support level on that big red candle right there, the drop. This is a 3-month hourly chart. Then you back tested it, got rejected. Put in a divergent low, gave us a little rally, back test. So this is my swing trading time frame. You look for these, here's a downtrend line there. There's a divergent low. You can rally right up to resistance, objective short entry. Then you put in, we continued down. We put in positive divergence here, this divergent low, and we've been in an uptrend since, right? Working our way up. But what was different from back here, this was early on. This was when we had the breakouts and TLT and a lot of that was that powerful buy signal I highlighted a few weeks back. I've been waiting for that for months. That was the breakout in TLT here. I'll show you. Most of you probably know if you took the trade, but there it is right there. Boom. And TLT is right up there. There's some resistance here at 104.72. Go back to ZB for your future traders, and that's that same level. That's resistance. That's what I just showed you on the TLT daily. So we're at resistance. It's about 1291 or so, and you have divergence that continues to build right now. There it is, divergent high, and we started to get a correction off that initial divergent high. We did get a little correction. We pulled back to support right here, 126.094. Bounced and made a marginal new but still divergent high, which simply extended the divergence. So, and hence the reason, for me booking some profits. And by the end of the day, there's a good chance I may take a short on here on Treasuries. We're still at that resistance level. I think it's a very objective short for a pullback trade. Let me give you one additional target because we might get I think we'll get a deeper pullback. Typically, the bigger the divergence, the bigger the pullback. Right here, right about, give or take this level right here. More of a zone. I'm going to give you a zone. So this would be a swing target zone for ZB. Anyone wanting to take a counter trend trade on the Treasuries. 124.079 down to 122.310. Those are, of course, the actual support levels covered below, but I think we might be able to make it down there. Oh, very important for me to add. Again, I keep been saying this the last few days. Remember, we have the FOMC meeting on the 14th. Markets may go into holding pattern, I don't know, but may not. Go off the technicals. There may be some, my guess is you'll probably see some profit taken on Treasury. It's been a nice run. I'm sure some others caught it like we did, and so maybe we'll get some nervous selling, profit taken into the Fed, and that would be the trade. But you want to be, you probably don't want to have any positions on Treasury bonds or anything interest rate sensitive going into that meeting 2 p.m. on the 14th of this month. All right, guys, I'm going to skip gold and silver because I gave you such an extensive update today with static charts. That one takes as long as to put together as pretty much this video so far to annotate and screenshot those charts, but everything else. So you've got that. It's pretty much the euros hit major downtrend line resistance on the daily, weekly. Again, visit that post on the page. You'll see why I think the risk reward right now is not very attractive, especially for new positions. I remain longer term bullish on gold and silver. I've made the technical case for weeks and months now. I've made the fundamental case that, hey, they are commodities. They are, even though they're precious metals, they're also commodities. They have big industrial uses, and it's as if gold and silver didn't get the memo that all other commodities are in a strong bull market. So they're playing a game of catch up, which I believe has more to come. However, near term, I think it's time to, for a more active swing trader, or even if there's a term, for active trend trader, to book some profits, at least tighten stops, or, like I shorted silver today, and still right about the highs where we were earlier today. It's had a little pullback. It's pushed right back up. So that's more of an active trade thing. Trying to game a pullback there. But what I'm giving you here, this is crude oil. This is a long-term chart. WTI, that's West Texas Intermediate Crude Oil. This is a chart this goes 20 something years back, and this was a big support level back here, and the years, this is 2012, 2013, 2014, and then in 2014 we broke that support level. Big level. We rallied back up to it here in 2018. We put in a divergent high when we hit it, got rejected. Nice smackdown right on the back test of that level. Got up there again for the first time since 2018. Back here in 2021, rejected again. Tried a little false breakout there, but finally got it on that last go around there, and this gave us a surge up here. So I wanted to point out we are at that's big support, and there's positive divergence here on the weekly time frame. So takeaway is of all commodities, that single-handedly has the biggest impact on inflation is crude oil, energy, and so this again doesn't help support the bullish case, the longer term bullish case in equity if this plays out. Now, look, divergence is not a buy signal. There's no guarantee you're going to bounce off support, but if crude does rally here in the coming weeks, this is longer term analysis. This is a weekly chart, and this divergence here is confirmed. And we hold that support level. Again, that's going to be a headwind for the equity markets because it's going to reignite the flames of inflation and force the Fed's hand again to come in and stifle economic growth with additional rate hikes. Okay, that was a 20-something year weekly chart. Zooming down, this is 6 months of price history of CL crude futures on a 2-hour candlesticks, chart of 2-hour candlesticks, that is. Not the best defined resistance level. I have it at 83.32, but I do have reactions there. Traded through it quite a bit here, but we had enough reactions there. There was one recently. Either way, that's a resistance level that we ran into. I took a pot shot short trade there at crude. That was yesterday. Was it? No, I did short it yesterday, and probably a little premature, but we're there. We just hit it today, and I'll show you that level up close. 3 months, we'll go down to an hourly chart, and if I put that same line up, that was pretty much yesterday's high. See, there was that most recent reaction high there. You can see enough, or I at least see enough candles there to say it's a moderate support level. Decent, not great, but you also had this negative divergence right here building, and there's your divergence lines there. I should use this tool right there, the line tool instead of the box tool. There it is. So negative divergence, and so like I said, on the that long-term weekly chart there at support, we just hit that support and we bounced so far. So I'm just looking, for a pullback trade, and I would add to my position if and when we break this minor uptrend line right here off the lows. And I gotta give you a target here. Got a level I've been eyeing. Minimum targets right here, 79, almost $80, and we could get a little more traction on that trade. This would be at this point in time max target. But I'm just looking for a quick pullback trade. And likewise, I just went long natural gas. Short crude, but long natural gas today. This is just a 10-minute chart. I did this just before the video. We've got some positive divergence here forming right there. If we can turn the PPO up, it'll be confirmed. There it is. Indicators making higher highs. This is just a little 10-minute chart. But when you go to the 60-minute chart, a little more significant, especially for swing or trend trades. Maybe I had it on a 15-minute. Let me make sure here. These contracts rolled recently. I might have another. There it is. It was a 15-minute chart I had marked up as well. So I just showed you a 10. This is very similar. That was 10-minute candles. These are 15-minute candles. But so there's your divergence. It's been building right here, and it's not a hard support level. I'd be a little more fond of this trade and a little heavier, or just small position. I think we're going to come up here and regain that what is that, 6,899, we'll call it 690 level. I've seen these two little whipsaws, two little false breakouts above this downtrend line recently. But if you exclude those, you've got this little wedge forming here. So if we can go up there and break out, I think you could run up here to that at least that 741-ish level right there. So I think it's if you want to take a shot at nat gas here. Again, these are natural gas futures. UNG would be your ETF, one of several, just the main one, non-leverage. And really, I can't make a screaming case for this one right now. I showed you why on the futures. That's really what I trade. They trade around the clock because natural gas moves so much. That's why I won't trade these ETFs, because you're trapped into them. Once the market closes, that's it. I know some platforms now have started to allow around the clock trading on certain ETFs. I have to imagine liquidity is like nil at 3 in the morning. So if there's a big move, something happens somewhere, news event or anything, natural gas can really run, and you can wake up to a big gap against your position that bypasses your stop. Whereas natural gas futures, like stock futures and crude futures, they're trading around the clock, so you can go to bed with a stop in place, and your price targets too. Can't tell you, it's nice to wake up and see that your price target was filled, your limit order on that. And last but not least, just a brief update on crypto. Crypto's been dead lately, with the collapse of FTX. And to me, most importantly, it's still below. This is massive support, 18,079 or 18, we'll call it 18,080. This is the actual crypto Bitcoin. And you can BRR Bitcoin futures, going to be the same thing. So we've been consolidating. We put in, as I mentioned recently, threw it out as a trade idea. There was a divergent low, and we broke out of the downtrend line. It's been stair-stepping up. This is resistance we're struggling with right now, or Bitcoin is 17,070 right there. It's really this recent trading range, if you box that in there. So if we can pop that, it may run for a back test of that 18,079, but just remember, it's still a bit toxic right now. We still don't know, are there any other shoes to drop in the crypto world? If not, I think it's, if we can get by the next few weeks here without another big, collapse of another firm or anything like that, you could see that level get recovered in a nice rally. Otherwise, you could see it drop. I don't have strong convictions, just like most things now in the stock market, treasuries, over the next few weeks. I think we're just going to kind of continue to chop around, but I still have a, if I'm looking out, in year end, what to do, whether to scale long or scale short or be long or short, I'm still leaning towards the short side in the equity markets. But again, not a hard short by any means, more of a scale in kind of thing, and need a little more evidence that, top is in. All right, I am going to wrap it up here. Let me just double check my notepad. Yep, I got everything I wanted to cover. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.